Hello and welcome to your ACCA F5 Performance Management Express videos. Before we go on with discussing the content of the syllabus in a very brief manner, highlighting the most important aspects of the syllabus, I would like you to draw your attention that these videos are going to be based on the express notes of the EXP group, and these notes can be downloaded free of charge from www.theexpgroup.com. After you've downloaded the notes, you can follow exactly the videos as we go on. The first chapter we're going to discuss is the specialist cost and management accounting techniques. That's basically what we are discussing here. There are costs. And if we carry forward our knowledge from F2, we already know that there is a traditional costing method which is based on the overhead absorption rate that traditionally was calculated as the budgeted volume, budgeted amount of the of an overhead divided by a budgeted volume. Right, and this basically was based on a single amount of a volume amount that could be production or usually labor hours, and this amount was divided basically this amount was used to divide the budgeted amount of the fixed overheads. Now the first part of the of your text deals with the activity-based costing, the ABC, which basically changes a little bit of the structure because groups overhead costs according to the activities causing those costs. So there's a big pool of the overheads and divides that big pool of overheads that we traditionally used to divide by a single amount of a volume, as I told you, divides them according to the activities that cause those costs. These are then cost drivers, and these can be linked to the activities, so can charge the costs to the agents undertaking those activities. We have a short example here, a factory clinic, that adds annual costs of $500,000, that's the budget amount, serves two workshops, A and B. The workshop A has 200 employees, B has 300. Then the traditional way of doing it, using the traditional OR of allocating the costs, would be simply based on the number of the employees, 200 and 300, and we would divide just simply apportionate. We would just apportion the total costs according to the number of employees. ABC might look something like number of visits, so a cost driver to the clinic by the employees of A and B. So let's say the workshop A has 150 visits per annum and workshop B has 70 visits per annum. In this case, the apportionment could be taking into consideration that the total amount of the cost driver is 220. We can divide the costs according to the number of visits. So workshop A incurs costs of $340,000 approximately, while workshop B $159,000. The different level of usage may reflect the different degrees of occupational hazard present in the two workshops. So it's not just like how many employees we have there, it's actually we are measuring how many times do they visit the clinic. However, using ABC, it might be a little bit complicated because it's costly to implement and it's also complex. Just imagine the real life, how much time would take you to gather all the information about the cost drivers, about the pools, then to divide them. It can be really complex. It's not easy to implement, so we and management always have to take care to match costs against benefits from ABC. Right, further on, obviously the advantages are that the costs are more precise if you determine them based on ABC, and planning, pricing decisions can be much more relevant using ABC than traditional costing. One more costing technique in your syllabus is target costing. This basically looks at the market, sets the price or takes the price from the market. That's a market price usually, out of which we deduct in the desired profit or the margin that we want to obtain, and what remains will be the target cost. Now this would be compared to our actual costs, and depending on whether higher or lower. If the target cost is lower than our actual cost, then we have a cost gap, what we call a cost gap here, and this cost gap must be closed by some ways, like for example using alternative materials or redesigning the product. Otherwise we're not going to meet the desired profit target. This is what target costing is about. So looking at the market, it's a market-oriented approach. It depends on the situation of our company on the market. Life cycle costing introduces the concept of the life cycle of the product that falls into several stages. It's market development, growth, maturity and decline. So as such, you can imagine that the life cycle of a product will not fit in basically in one accounting period. So what life cycle costing does, looks at all of the costs during the life cycle of a product and divides it, accrues it evenly throughout the accounting periods. This is basically used because most of the costs are incurred in the research and development phase, which are not even included in the cost card of the product. So we want to have a holistic image of the cost of a product to have an accurate determination of the costs. Throughput accounting is one more, furthermore, a costing technique. It is very similar to marginal costing, just that now instead of margin we have throughput, that is calculated, throughput, that is calculated using the sales price less direct material costs. Throughput accounting considers all other costs besides direct materials purchased as fixed costs, even labor. Yes, and then it goes on computing the well-known throughput accounting ratio. That's return per factory hour divided by cost per factory hour. And obviously ranks, if we are dealing with multiple products, ranks the products according to their throughput accounting ratio. It is consistent and used in just-in-time environments where basically no inventories are produced. We don't produce on stock. We consider we are identifying bottlenecks and we want to use or make as much use of those bottleneck resources as we can. This is why we use throughput accounting. And don't remember please that throughput accounting treats all of the costs, yes, as fixed, and treats only direct material costs and as being variable in the short term. Now note that there are three ratios that you need to compute. The throughput per factory hour, that is the throughput per unit, which we just determined up here. So that's throughput per factory hour. Per hour. Then you have something that is called cost per factory hour, right? Factory hour, and by dividing those two, you'll come up to the throughput accounting ratio. This would be the end of your first chapter. We're going to discuss in your next chapter the relevant decision-making techniques for your paper F5. See you there.